Hi, and welcome to the latest monthly update from Zurich Life. I'm Jacqueline. I'm joined today by our investment solutions analyst, Daniel Finucane. We're here to break down the latest market developments and what they could mean for your portfolio up until Friday, October 17th. Good morning, Daniel.
Good morning.
So let's start with the bigger picture. Can you share some insights into the key factors that would have driven performance in September 2025 and highlight any notable sectors or market trends that would have stood out?
Yeah, thanks very much, Jack. I guess what better way to start than just taking a look at the relative performance of equities and bonds so far in 2025. In this chart here, I have the return on the MSCI World in euro terms in the blue line, and in the beige line, I have the return on European government bonds. And so when we look at the blue line, you can see there in early April, we had those April lows around Liberation Day and the imposition of tariffs. But we've had a very swift recovery since then, and you can see very strong momentum in equities. Equities now very much in positive territory year to date. And that momentum was really driven by this AI thematic, which we've had this year, and that carried over into September as well, defying really the reputation that September has as the weakest months in the stock market. The US equities actually had their strongest September in 15 years, and that was really supported by the fact that the Fed cut interest rates for the first time in 2025, so supporting equity prices there. And we also saw very low volatility as well in September, and in fact, we've seen very smooth returns in Q3 overall. And that was even despite instances like US President Trump threatening 100% tariffs on pharmaceutical imports. And we also had the run up to the government shutdown, and which we eventually did see on October 1st, and it's still ongoing today. But that, unfortunately, that low volatility didn't carry over into October so far. We have seen a spike in volatility and a pullback in equity returns. And that was due to President Trump issuing a threat of 100% tariffs on Chinese imports, so bringing up those trade worries again for investors, which has made now the outlook for equities looking forward into Q4 a bit more nebulous, you could say.
Okay, that's all really interesting. You touched on equities there as part of the overall picture, and there's a really interesting fact about the equity performance being the best September in 15 years. So, what stood out from a sectoral and geographic perspective in terms of equities? You're on mute.
Yeah, so I guess if I take a look at the sectoral returns since the start of September, you can see them all listed out here. And what might not be surprising, given what I said about the momentum of that AI trend, is the fact that the IT sector returned very well since the start of September. But what might be a little bit more surprising is the fact that utilities are actually leading the pack in this period, which might be a bit surprising because we would usually consider the utility sector to be a more defensive sector. And so it's usually a lot less sensitive to the overriding market sentiment. Usually we see a lot more muted returns in utilities, either up or down. But this brings up a really key point of consideration around this AI revolution. And that's the fact that when we see innovation in the technology sector in particular, we usually see a spillover effect into other sectors then. And that's what we saw this month in the utility sector. These stocks did very well due to a higher demand for power. And that demand for power has been coming from the higher demand for data centers, which are used to facilitate this AI growth. And so a query in ChatGPT, for example, uses about 10 times the amount of power as a regular query on Google. And so there's a really strong demand for power being generated by this AI trend. And we saw a lot of announcements of new contracts for the building of new AI infrastructure during the month of September. And that brings me on as well to my next point. Around this AI thematic, this AI trade, we saw a lot of notable movements in particular stocks in the month of September. I've picked out three examples here. So we have CoreWeave in the dark blue. This is a an AI cloud computing company. They announced a number of multi-billion-dollar contracts during the month. We also have AMD in the light blue line, who announced a partnership with OpenAI during the month and saw their stock price spike up. And we have Oracle as well, which announced a partnership with OpenAI as well to build new AI infrastructure at the start of September, and we saw a real skyrocket in the stock price at that time. Larry Ellison, the co-founder of Oracle, saw his net worth jump by $100 billion in one day. Um, and these three stocks in the period since the start of September have returned over 30%. And so are really high returns in a really short period of time. And that really demonstrates the strong optimism that investors have around this AI revolution.
Yeah, lots happening in the IT sector at the moment. Moving to another asset class, if we're to look at fixed income, can you give an overview of the major central bank decisions and the different bond market developments in September and the beginning of October? Specifically, what actions did the Federal Reserve take, the European Central Bank, and how did these moves impact the relative regions?
Yeah, so what was very notable in September was the fact that the Fed recommenced its rate cutting cycle, issuing their first rate cut in 2025, and that was due to the fact that the labor market in the US has been showing some signs of weakness, and so the Fed have a dual mandate of price stability and of maximum employment, and so they're really adhering to that dual mandate, and they're expected again to cut interest rates in late October as well. So while the ECB kind of led the year in 2025 in terms of rate cuts, it looks like the Fed are starting to catch up. And in fact, the ECB also had a rate meeting in September where they decided to maintain interest rates. And what was notable is that they actually said that they would now be taking these rate decisions meeting by meeting, as they're keeping a very close eye on inflation. Inflation in the Eurozone did rise above 2% in September for the first time since April. And in terms of the effects that this has had on Eurozone bonds, what I have here is a German 10-year bond yield. And it really had a muted impact on bonds in September. You can see here over the course of the year that this bond yield has been very volatile due to the fiscal reform, which we've seen across the continent this year, investors pricing in their worries around widening fiscal deficits. But what we have seen since the start of October is these bond yields have come down a bit. Starting at about 2.7%, they've come down to 2.64. And that's due to what I mentioned earlier, this heightened volatility now in October around these renewed fears around this US-China trade debacle, if you want to call it that.
Yeah, it's very unusual to see volatility, so much volatility in bond markets, but I suppose it's reflective of the uncertainty that's in the market. Turning to commodities and currencies now, what were the main moves in September 2025?
Yeah, so I guess starting with the dollar, which of course has been a very key talking point this year. This is a slide that we've used a lot in our presentations. Is the Euro USD exchange rate. You can see the dollar weakened considerably since the start of the year, and that of course has detracted from European investor returns into US assets. But if you look there at the end of that graph, or the last couple of months, say, we have seen a bit of a stagnation in this exchange rate. So that's allowed European investors to really benefit from those high equity returns in the US, which I noted before. And actually, in the last couple of weeks, we also saw this exchange rate actually weaken on the euro side. And so this exchange rate actually now in the last couple of weeks has been positively contributing to equity returns. So imagine that. And really, that's been due to the euro weakening, which has been attributable to political strife in France, in particular, of course, a leading economy in Europe, and really now a focal point and an area where people are really judging the eurozone stability. But if I move on now to our commodities bucket, the dollar weakening in 2025 has really been gold's gain. So gold again this year has continued its really stellar run that it's been on. Um, and that's been supported a lot by a really aggressive buying of gold by central banks, particularly in developing nations where they're looking to diversify away from this weakening dollar and into gold. And if you look there, since the start of September, gold has really taken off again. And that's been helped by the fact that the Fed cut interest rates and due to the expectations for them to continue cutting interest rates in October. And it's also been helped by uncertainty around the US government shutdown and these renewed tariff fears as well. Um, if I turn if I turn to oil now, while gold and oil are both commodities within our alternatives bucket, they do of course behave quite differently, and that's really been demonstrated this year. Oil has been very volatile, particularly in relating to geopolitical developments. But we've ultimately seen the price of oil fall nearly 30% year to date, and that's been due to the US and OPEC's plans to ramp up oil production. And we also saw in the last couple of weeks oil prices fall even further, and that was due to the ceasefire which was announced in the Middle East.
Okay, the slide does really illustrate the benefits of diversification really well. Finally, if we're to look ahead, what's Zurich's short to medium term outlook, and how are Zurich investments positioning our portfolios?
Yeah, so I guess the easiest way to talk about our outlook is to really look at our current positioning. And so if I first look at equities, we are currently modestly underweight equities within our multi-asset funds. And so what that means is that we're operating right below the midpoint in terms of our equity allocation in our AAA and our Prisma range. And so the current risk return trade-off in equities meriting a modest underweight in our view. From a regional perspective, we do have a preference for Asia Pacific. That's a preference we've held throughout 2025, really taking advantage of the strong momentum there. And in terms of sectors, we do have a bias towards cyclical growth sectors, particularly the tech sector, of course, taking advantage of that AI trend, which I've mentioned. We are overweight in terms of government bonds, and we do have a modestly short duration position. So what that means is that we are less sensitive to rate changes, and we do favor periphery issuers like Italy and Spain over core issuers like Germany. Um, we do also have a preference for credit over sovereign debt. Um, the credit spreads at the moment are at historically narrow levels in Europe, but particularly in the US as well. Really tight credit spreads, but credit yields are still elevated above recent historical averages, and so there is still a positive return to be had in credit. In terms of alternatives, then we do still maintain a materially overweight position in alternatives, particularly in gold, which, as I showed in the previous slide, has been on a really stellar run, and there's still a lot of structural forces backing momentum in gold. And finally, in terms of currencies, when we've been queried on a lot this year in terms of a US dollar hedge, we don't currently have a US dollar hedge in place, but this, of course, is always under active consideration by the Zurich's investment teams.
Hey, very interesting. It shows it really argues the case for active management, particularly in periods of uncertainty and high volatility. It's good to see the moves that Zurich investments are making at the moment. I'm going to wrap up with that. It brings us to the end of this month's update. So thank you, Daniel, for sharing Zurich's perspective on investment markets. And we hope you found these insights insightful and valuable. Please feel free to share this video, and we look forward to having you with us again next month for more details on the Zurich fund range. And download the latest monthly investment reports or the Prisma monthly reports, visit zurich.ie. Thank you.